London Ambulance Service Financial Wellbeing webinar with First Mortgage. For those of you that haven't attended these educational webinars previously, I'll talk to you a bit more in a bit more depth in terms of the service that First Mortgage offer and the collaboration that we've got with London Ambulance Service and a few other NHS trusts as well. Today's topic is going to be on remortgaging and how to raise funds for obviously your own personal consumption or even to raise funds to consolidate debt. And that's basically going to be discussing the rationale for sort of raising money, whether it's sort of purposes to raise money to sort of improve your property or sort of buy a car or whatever it's going to be, or basically just to consolidate debts and improve your cash flow in terms of reducing your monthly outgoings. So today's agenda, first of all, we'll discuss who are First Mortgage, what services do we offer, and what the benefits are that you receive through being an NHS employee. So First Mortgage, first of all, we're an award-winning firm of mortgage and protection advisors. We've got a speciality in financial wellbeing. We provide the mortgage service for over 100 NHS trusts across the UK. We work really closely with London Ambulance Service, with Manchester Foundation Trust, the North West Ambulance Service, as well as University Hospitals Birmingham, over 100 NHS trusts, as well as a lot of the MOD sites in the public sector. In the private sector, we've got contract with Amazon, so we provide the mortgage service for all of their staff in the UK. And all our staff are very highly experienced in dealing with NHS employees in terms of providing mortgages for NHS staff, albeit whether they're using basic salary, whether they're using overtime, whether they're using bank work, whatever sort of form of income. We've seen it all before. And our guys have placed hundreds of cases for NHS staff over the years looking to buy properties or consolidate debts and remortgages. So we provide a fee-free service, completely free of charge in terms of the initial advice we provide, as well as providing the support and guidance to apply for the mortgage and get the mortgage offer issued. We get paid by the mortgage lender on completion, so there's no fee at all to NHS staff, and that offer is extended to your friends and family as well. So if you've got any friends or family that want any free advice mortgage-wise, feel free to pass the details on. You'll see on the screen, every screen I go through today, our contact details are on the screen there. So you've got our website, firstmortgage.co.uk. Email address to contact the team directly to book an appointment free of charge is hellobath@firstmortgage.co.uk. And telephone number 01225 970 830. So we generally provide a free consultation, which is about 30 to 40 minutes initially. That's usually done over the phone or on a Teams or Zoom call, whatever your choice is. And that's basically booked in with one of our mortgage experts, and we'll have ongoing support all the way through. So we'll then give you all the information, financially qualify you, give you an idea of what your circumstances are. We can then provide you with a formal recommendation. And if you want to apply, one of our team will basically do the application for you. And again, there's no charge to you throughout the whole process. As part of our service, we also provide a free protection review as well. So you want to make sure that you can afford a mortgage both now and in the future, amongst obviously whatever life throws at you. You want to make sure that financially you can cover yourself. So should the worst happen, if you've got a joint mortgage, one of you pass away, or should you be diagnosed with a serious illness, we want to make sure that you can afford to maintain your mortgage payments and afford all your bills. You're never in a position whereby potentially you've got to sell the property to maintain your mortgage and all the bills there. So that's part of our process. In terms of our staff, so we've got a lot of brokers here who are very highly experienced. Amongst us, we've got the best overall advisor in the UK, as voted for at the British Mortgage Awards, the best new build advisor in the UK, the best first-time buyer advisor in the UK, amongst many other experienced staff here. So you're in very safe hands when you speak to us. We know what we're doing. And we've got over 30,000 five-star Trustpilot reviews for First Mortgage as well. So in terms of NHS staff, first of all, before we look at the options for remortgaging to consolidate debt or raise capital, why do NHS staff receive special consideration? So essentially, historically, I guess there's been a misconception in the market that NHS staff will struggle to get a mortgage, but actually mortgage lenders recognise sort of the highly valuable social role that NHS staff play. The fact that you're in a stable employment and there's rarely, touch wood, many redundancies across the NHS. Obviously, it's a massive industry, and it provides obviously a great support network for everyone. And there's also a very strong demand for homes across NHS sites, a lot in terms of the infrastructure around hospital sites. Thousands of staff work at any one site, and so there's often strong demand for sort of new build homes and properties built and bought by NHS staff around those homes. Because of that, there are certain available schemes available to NHS staff, which we can discuss a bit later on, which allow NHS staff sort of to buy at a discounted value, and you often get access to a sort of hero range products for NHS staff as well. So looking at purposes to raise capital for against your home. So generally people, we'll go through the quick definition of that. So what does capital raising mean? So essentially capital raising is where you use the equity you've got in your property to take out further borrowing against your property. So it might be you've got a mortgage already, but say you've got a property worth £300,000. You've got a mortgage in place, you owe £100,000. You've then got £200,000 of equity remaining in the property. Now you can use that equity to release some of that cash and capital raise to release those funds, basically to use for whatever purpose you like. I say whatever purpose you like. There's a caveat there, which I'll go through in terms of what you are allowed to and what you're not allowed to use the money for. And what you then do is take out further borrowing against your property on sort of a secondary mortgage rate, which is still a first charge mortgage secured against your home, and you can use that money to do what you want with. So people generally remortgage to one on a like-for-like basis on a switch to ensure you don't revert onto the lender's higher standard variable rate once your current fixed deal ends. So people will swap onto a new deal, and obviously they use us as a vehicle to basically provide the best mortgage solution, shop around and get the best rate, and transfer that mortgage over to a new deal. They often use remortgaging as a purpose to reduce the monthly payments, to get a better rate and shop around, sometimes paying an earlier repayment charge to come out of their current deal if it makes financial sense to do so, which we can recommend doing or not doing. The most common one, I guess, is to raise money for home improvements. So certainly born out of the pandemic in COVID, the purchase market didn't fall flat, but certainly it declined rapidly. And a lot of people decided to stay where they were, but actually extend their home or improve it. Basically for this new way of living, as a lot of people now work from home as part of their sort of daily job roles. So people have home improvements, whether they extend into the loft, whether they extend at the back, whether they just want a nice new kitchen or freshen up. People raise money against their property, release equity of home improvements. And probably the second biggest one is for debt consolidation, where people have got credit card debts or loans and they're struggling to meet the mortgage payments, so the monthly payments. And it might be worthwhile consolidating those debts into the mortgage. So you've got one nice, clear, concise monthly payment going out, which is easier to manage. And it means then that it can potentially reduce the short-term monthly payments, although there are caveats in that in terms of longer-term interest paying if you are consolidating a short-term debt into a long-term mortgage, and obviously paying the mortgage off over a longer period of time. But we'll discuss that in a bit more depth in a minute. So delving down into the reasons that you can raise the money. So again, generally speaking, most high street lenders will allow for consumer goods, which is things like buying a car. I've done mortgages for people who are getting married and want to raise 40 grand against the property to pay for the cost of the wedding. Debt consolidation, again, that's consolidating credit card debts or loans or car finance into the mortgage. Some people have got children that they want to basically provide money to help them get on the property ladder. So people release money to give their sort of children a gift or to a relative to sort of buy a property or do what they want with. Again, home improvements is a major one. People take out money against property to improve the overall value of the property. So it's seen as investment, and lenders like that because obviously you're improving the value of the property, which reduces the risk of the lender. So that in the event you were to default on the mortgage payments, if they sell the property, it's actually worth more money. So it's worthwhile then giving the money for those purposes. People raise money to buy a second property. So as a buy-to-let investment, they might want to use your money to work more smart, release money and basically provide that towards putting down a deposit on a new property as well. A lot of people who are living as leaseholders in a flat will use the money to release the equity from property to purchase the freehold. People often use the money to purchase land as well. If they've got adjacent land next to the property and they want to develop that land, they buy that. Or even for a shared ownership mortgage, people want what's called staircase and raise the money to staircase and buy a bigger value or bigger percentage of the property. In terms of what you're not allowed to use capital raising for, so people often come to me and say, I want to pay a tax bill. Generally speaking, that's not allowed. Lenders won't let you raise money against your home to pay a tax bill. Any illegal activities, this might sound pretty obvious, but anything like any illegal activities involved, obviously in terrorism or in any crime, obviously not going to be allowed. But also speculative purposes. So, for example, investing in the stock market, lenders generally don't like that. It's seen as a form of gambling. A lot of lenders don't like crypto schemes as well. So if you're trying to raise money to invest in crypto, or trying to raise money to provide funds towards a political party. Again, this isn't very common, but just outlining some of the sort of the no's that lenders don't like you raising money for. Business purposes, there is large restrictions. The majority of lenders don't like you raising money for business purposes, especially for a startup business. Although if you've got an existing trading business and you're looking to raise money against your home, there are 3 or 4 lenders we've done mortgages for in the past that will allow that sort of purpose for you. So those are the reasons you can raise and can't raise money against your home. In terms of what to do if you can't afford your mortgage repayment, so this is more to do with debt consolidation and general advice over affordability amidst the cost of living crisis born out of the pandemic. People have really struggled with their mortgage payments. Obviously, interest rates rose dramatically after the disaster of the mini budget in October 2022, when Liz Truss came in for that 45-day period. As a result, rates have remained pretty high since then, whereas previously, prior to October 2022, they were down to as low as 1%. We're now seeing average rates between sort of 4.25 to 4.75% in the current market. So if you can't afford your mortgage repayments, first thing to do is contact your mortgage lender. Your mortgage lender is there to help you. They want to work with you. The last thing they want to do is sell your home to get the money back. So give them a call. If you just ignore the problem, the situation will get worse. So speak to your lender early if you can't afford the mortgage payments, because there are plenty of options available to try and reduce your monthly payments and help you financially. So again, born out of the pandemic and again amidst the cost of living crisis, the Mortgage Charter was born. The Mortgage Charter effectively is a charter of rules or principles set out by the government, which effectively is to remedy home owners and help them financially, obviously in uncertain times. So it's all regulated by the Financial Conduct Authority, governed by them, but the majority of mortgage lenders have signed up to the Mortgage Charter. And effectively, it just basically means, or the worst part of it means for homeowners, if you can't afford the mortgage payments, you've got 12 months to sort it out before a mortgage lender can effectively kick you out your home, sell the property, and pay the mortgage back. So it gives you a full year to think of all other sort of means of payments to maintain your mortgage, to basically allow you to stay in your home. So there are three principles really with this. So again, the first one I've already covered. So not to force a borrower to leave their home without their consent in less than 1 year after your first missed mortgage payment. Okay, the Mortgage Charter also allows customers to lock in a new deal. So if you're remortgaging, it allows you to basically secure a new deal in a very quickly and rapidly changing rate environment up to 6 months before the current deal ends. And also, which is really helpful, as a short-term measure, it allows everyone to apply to switch their mortgage onto an interest-only basis. So you only pay the interest, you don't pay the capital for up to a maximum period of 6 months if you are struggling with your mortgage. And there's no underwriting, there's no application checks. Just call your lender, say, I'm struggling with monthly payments. Can you please switch me onto interest only for 6 months whilst I catch up? Bear in mind, if you do that, you switch your mortgage onto interest only, it's going to cost you more money in the long term. Okay, that debt isn't going to go away. It just gets delayed or postponed for 6 months. And that debt of 6 months will get added onto the overall balance. So if you're paying £1,500 a month, you're going to get 6 times £1,500 a month plus the interest on top of that. You're looking at £9,000 in addition as a minimum added to the overall mortgage debt at the end of the term for you. But yeah, the Mortgage Charter allows you basically to sort out your finances should you miss any payments on your mortgage, and you've got 12 months before you're repossessed. Allows you to reserve a new deal if you're remortgaging up to 6 months before your current deal ends. And it also allows you to switch in interest only for a maximum period of 6 months to reduce your monthly payments down if you are struggling financially. So it's a short-term solution, but the long-term solution might I said the long-term effect of that might be you pay more interest. So if you do want to discuss that with us, speak to one of our advisors, book in with the team. Obviously, ask me. You can email the team here, hellobath@firstmortgage.co.uk. Give us a call, discuss your options if you are struggling, and we can basically advise you as regards the best thing to do. In terms of other longer term steps available for your mortgage if you are struggling with mortgage payments, so I've detailed on the slide, you'll see a number of options. So number one, first step, again, I've mentioned already, contact your lender. They will work with you. They've got dedicated people available to answer these calls all day long. Speak to them and they will provide a number of solutions, whether that's increasing the mortgage term to reduce your payments down, having a payment holiday for 3 or 4 months to basically allow you to catch up on any other bills. There are other options available too. So consider a payment holiday. Number two, I've already just mentioned. Okay, as a short-term fix of 3 to 6 months, it might be you stop paying your mortgage for 3 to 6 months. That balance that you haven't paid is added onto the balance overall, but it might just allow you to kind of have an overdraft or catch up and pay some of the bills off. So you've got more disposable income. You can then concentrate on paying the mortgage once that period's finished. Reduce your mortgage payments. So if you can't afford to pay the full amount, it might be the lender will accept a lower payment. And again, they can look to extend the term to catch up on mortgage payments in the future. Also check for government schemes. Support for mortgage interest is the SMI scheme. If you are receiving other benefits, it might be you qualify for the support for mortgage interest. So if you speak to the government and get on the government websites to see if you qualify for that. There's also, worst case, what's called a mortgage rescue scheme in the UK. So it might allow you potentially to sell parts of the home or percentage of the property to the government for in exchange some cash to basically help your situation financially. Do seek independent financial advice. Speak to an IFA if you can do, or a debt advisor. We've got access to a number of debt advisors in our network. We speak to a lot of people who do struggle financially. You can speak to Citizens Advice, Pay Plan, even the National Debt Line, a number of fee-free advice UK debt charities, which will basically have a number of solutions for you. Number 6, reevaluate your budget. Go through your bank statements, see what the essentials are. You'd be surprised how many people are paying X, Y, and Z subscriptions for things they don't even use because they haven't checked their bank statements for years. There might be easy ways to strip out money out of your bank statements going out monthly, which means the monthly payments on the mortgage will be affordable, but you've got other payments going out which are just not on top of. Worst case, you can look at selling the property. So if you really can't afford the mortgage is too big, can you downsize? Are there any properties in the area which you can downsize to and basically use the equity in the home to buy a smaller property and have a smaller mortgage to reduce your outgoings? But the major thing is to try and avoid repossession. Repossession is whereby the lender sells the property in order to claim back the debt in the event you can't afford the mortgage payments. We obviously don't want you to do that. So by all means, reach out and speak to us. But that said, in summary, there are a number of options available for you. So if you are struggling with monthly payments, don't panic. Okay, for a start, you've got 12 months to fix it. You've got a number of different options available to speak to in terms of the advice we provide, number of debt charities we use, and all other sorts of options available, which might be sort of outside the box thinking for you. But there are plenty of options available to help you financially and get you back on the right track. So does it make sense to consolidate your debts into your mortgage? So there are a number of advantages and disadvantages of basically consolidating all of your finances into one solution, which is, for example, the mortgage payment. So number one, it might often be that you've got low monthly repayments. The reason being is you're spreading the debt over a longer period of time. So for example, you've got a credit card of say £5,000, which naturally would be paid off within 6 or 7 years. You pay that into the mortgage, or sorry, you add that into the mortgage, but the mortgage over 25 years. Of course, because it's over a longer period of time, those monthly payments are going to be lower. So of course, in the short term, it's really going to help you financially because you've got lower monthly payments. It might be the mortgage is on a lower rate versus the credit card as well. So you've got to have lower monthly payments, you've got lower interest rates as well. And you've got a single payment going out as opposed to your mortgage and a credit card debt as well. So you've got improved cash flow. It will also improve your credit score as well because you've then effectively cleared your credit card because you've added it into the loan. So by the lender's point of view, you've paid your credit card debt off. So those are the advantages: low monthly repayments, you've got one single payment, lower interest rate, improved cash flow, and credit score improvement. What are the disadvantages of doing so? So first of all, that debt is then going to be secured against your home. So that's a bigger risk to you and your family if you've got family. If you are repossessed, okay, you've got a less than that. Using that same example, you've got £5,000 more debt on your home, which means if the lender sells the property and pays the mortgage back, you've got £5,000 less equity coming to you if they sell your home. You're extending the repayment term, which means that credit card debt could have been paid off over 6 or 7 years. Actually, you're now going to pay it off over 25 years. You might have potential fees to pay as well in terms of early repayment charges on existing mortgages or loans to pay by consolidating those debts. There's also a risk of negative equity too. So in the event that the property value decreases, and because you've added more debt onto the mortgage, again, you've got less equity in the property. And if you've got a lot of debt and properties prices really drop, you could find yourself in a position whereby you owe more versus the value of your property in the future. The major one there, which is on the slide, major disadvantage is you'll pay a lot more interest over the mortgage term because you're adding debt into the mortgage and paying it over a longer period of time. So of course, you're going to pay more interest overall. So although it is a short-term fix to consolidate debt into your mortgage, it's worthwhile speaking to the team here. We will advise you financially against whether it's worthwhile doing financially, if there are any other options for you. Because if we can, we'll try and avoid you consolidating debt into the mortgage. But worst case, if that's the best thing to do financially, and you're happy to do it, we will advise you to do that. In terms of borrowing power for an NHS employee, so this doesn't just apply for London Ambulance Service, it applies to all NHS staff too. So generally speaking, the average income multiple lenders use up to 4 to 4.5 times income. So if you've got a basic salary of say £45,000, the majority of lenders out there will lend you up to 4.5 times income, which is a mortgage of £202,500. We work with a number of mortgage lenders. We've got access to over 100 lenders in the market at First Mortgage here. And we've got a lender that simply by virtue of the fact that you work for the NHS, you can borrow up to 5 times your income straight away. So rather than borrowing 202,500, you could borrow £225,000, which is £22,500 more straight away, just by virtue of the fact you come to First Mortgage and our mortgage experts have placed you with a lender who will lend you 5 times income, available up to 95% loan to value for a new mortgage, a purchase, or a remortgage for you. We've also got lenders available as a first-time buyer who can lend up to 6 times income as a first-time buyer, subject to qualifying criteria. So using that same example, if you earn £45,000 a year, rather than borrowing £202,500 maximum, as you get told by every other mortgage advisor you speak to, we could let you borrow up to £270,000 based on a single salary of £45,000. So again, if you are looking at buying a property or remortgaging and you want an income stretch, speak to our team here. We've got access to over 100 lenders and we can get you a scheme where you can borrow a hell of a lot more versus the majority of high street mortgage lenders out there. I mentioned at the start, we've got a financial protection process here at First Mortgage. So our job, of course, is to make sure you are covered financially against any mortgage debt you take on now or in the future. So our protection advisors will discuss all things like life insurance, critical illness cover, income protection and family income benefit to make sure that you are financially resilient against the worst happening to you, both now in the medium term and in the long term. So should the worst happen, we never want you to be in a position whereby you've got to sell the property to pay the mortgage back because you can't afford the mortgage payments. We will ensure you have a full one-to-one consultation with one of our team here to discuss yourself and your family's needs to ensure you are all financially protected for the future as part of the mortgage journey. So that's the end of the slideshow, but by a very quick market overview in terms of where mortgage rates are now and where interest rates are heading. So at the moment, the Bank of England base rate is currently held at 3.75%. That was held again last week at 3.75%. Probably 6 weeks ago, 8 weeks ago, before the Iran conflict came about, I'd be sat here saying that we're expecting the base rate to reduce by 2 or 3 more times this year, and the Bank of England base rate to be dropped down to about 3% by December 2026. The Iran conflict completely changed the trajectory of the UK interest rate outlook. Reason being is that it had a big impact on inflation, and I guess the expected rise of inflation is still to come in the next 2 or 3 months. Inflation is currently at 2.8% right now in the UK. We're expecting, or economists at least, are expecting that to rise to around 3.6% over the next 2 or 3 months. So the Iran conflict completely has changed the sort of, I guess, the shape and direction of travel of interest rates. Although going against the caution, I guess now, where we thought at the start of the conflict that interest rates could really rocket up, it's actually now expected that the interest rates may only increase by up to 0.25% between now and the end of this year. So we can see base rate 3.75% now. It might well be that as inflation ticks up from 2.8% to around 3.6%, the expected peak over the next 2 or 3 months, we should see that the Bank of England base rate should hold at 3.75% or may, very worst case, rise by 0.25% up to 4% overall. It should then start to drop back down later into 2027 as the inflation numbers come back under control towards government target of 2%. So the consumer price index, inflation is a headline inflation figure the government look at. Their target is 2%, and assuming that things are stable in the UK and inflation is around that level or just hovering above it, we should then start to see base rate drop back down. So I attended a conference this week with HSBC, one of the biggest lenders out there, and they're expecting that as of November 2027, Bank of England base rate is going to start to drop down at that point, and we should see by early 2028 the base rate start to really sort of rocket down towards the 3%, if not lower. So mortgage rates where they are at the moment, mortgage rates are sat around 4.25 to 4.75%. Based on predictions, everything we're hearing, mortgage rates are likely to start by the end of 2026 with a 3. So I think we're looking at high 3s. I say despite all the issues with Keir Starmer resigning in the recent days and the potential of the new Labour leader, Andy Burnham, coming in, the government gilts, which is sort of the government investments, they haven't changed at all. The swap rates haven't really moved, which is the rate that lenders lend to each other in the interbank market. As a result, things are likely to be stable in the mortgage market, if not have a little bit of, I guess, competition amongst all the lenders. On that basis, they are going to price quite competitively for the last 6 months of this year to try and make sure they hit their targets. And as a result, we should see mortgage rates drop a fair bit down over the next 6 months, starting hopefully towards the end of 2026 with the 3, rather than starting with the 4 at the moment. So that has been a very quick stop tour of the remortgage market in terms of how to use your equity in your home, either to capital raise or to use the money for debt consolidation. I'm going to stop the recording now. and this will all be uploaded onto the relevant portals by the wellbeing team at London Ambulance Service. So stop the recording and anyone on the webinar can ask any questions.